Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Happy January payday week to those who celebrate. I'm sure you are thoroughly looking forward to your salary landing in your bank account, and I think the retailers are looking forward to that too because they want to welcome you back to their stores. And retailers are what we will be talking about today. But before we get to that, in December, I released a Supernatural Stocks podcast that dealt with the different groupings that I've noticed on the local market when it comes to PE, that's price earnings multiples. You get the sub-10s, these are the really downtrodden or slow growth stories. Occasionally also cyclical plays that just happen to be at that point in the cycle, you'll find them there. Then you get the teens, which is where most local companies should be trading, in my opinion. If you just invert it and look at the earnings yield, it kind of makes sense. And then you get the over 20s club, reserved for really only the best local companies. Well, the best local companies and the ones that got the market all hot under the collar, even if it was only temporary. You see, when there's an encouraging story on the JSE, the market behaves like they're at the Oscars. Everyone stands up and claps, patting each other on the back about how clever they've all been. The share price climbs dramatically, getting to a PE of over 20 if all the right underlying buzzwords are used. At the end of the day, money is made or lost on the market based on what actually happens to share prices, not what should happen or what academic debates would suggest is correct. That's the beauty and the cruelty of the market all at once. There's a scoreboard, and there's a very clear way to measure success. Last week, I released a podcast talking about what a mistake looks like in the market and the need to not be too hard on yourself, to be careful about defining something as a mistake. I used Karoo as an example, where I had reduced some exposure in the past couple of years and then missed out on some of the upside that has happened. I concluded that with the information that I had at the time, reducing was probably the right call. As for Mr. Price though, I made a mistake last year, an outright mistake with my expectation for the share price. In July 2024, I gave my analysis here on Supernatural Stocks with cash build as a bullish story and Mr. Price as a bearish one. So, what happened? Let's get straight to the bad news. I was wrong. In fact, I was spectacularly wrong on one side of that cash build Mr. Price equation at least. Mr. Price was trading at around 200 Rand at the time of the podcast. Now it sits at just under 260 Rand. That's a 30% return on a stock that I thought had run out of puff. Ouch. But here's the thing. I think there's a chance we may well be heading back down towards that sort of 200 level. We might not get all the way there, but I think the direction of travel for now at least is down. You see, Mr. Price became part of that elusive over 20s PE club that I spoke about at the start of the podcast. Does it really deserve to be up there? Is there something so special about the Mr. Price model? Sure, sales growth has been solid recently and they've been winning market share. But a PE of over 20, which when you invert it means an earnings yield of under 5%, that's nearly the same multiple that I can go and buy Nike on at the moment. The market seems to have caught on to this, with the share price down nearly 12% in January at time of recording. This is despite a bullish release from Mr. Price that talks to double-digit sales growth. They use the words market share several times, and investors usually just lap that up. But not this time. After immense exuberance in 2024, punters came into 2025 and chose violence, taking profits and hurting share prices in the first month of the year. The lesson here for me is to never underestimate just how far a local stock can go before it starts to roll over. To be fair, we do see this in the US as well. We just see it on far more exciting names like Nvidia, rather than Mr. Price. This is why short positions are way more dangerous than long positions and why I leave the execution of shorts to traders and hedge funds who are set up for them. They are tactical, high-risk plays that can generate wonderful returns if you get them right and can practically wipe you out if you get them wrong. Also, if you're wrong on a long position, the passage of time can often save you, as most good companies do go up over a long enough time horizon. If you're short and caught, as they say, then losses are likely to compound over time rather than diminish for exactly the same reason. Most stocks do go up over time. You can be bearish on a stock and just avoid it in your portfolio without having to go out there and actually short the thing. But it's not just Mr. Price. The Mr. Price share price pressure is not unique this month. Truworths at time of recording down 13%, the Foschini Group down 8%, Pepkor lost over 9%. Clearly, there's a rolling over of retail stocks after they went too far in 2024. Januworry is here, at least for retail stocks. This is where you will typically then see traders jumping in because they wait for signals of weakness before bravely going short and trying to lock in tactical profits. Other traders like to get in earlier. They don't always wait for a big signal, they wait for a smaller one. And when they're right, they obviously lock in an even better move. Now, when investors like me start feeling bearish about a stock, it's usually still a while until traders pull the trigger. And then depending on the strategy used by those traders, they'll either wait longer or they'll get in fairly early and see what works for them. And each trader tends to figure out their style over time. But the common thread here is that traders watch momentum in the stock and they wait for it to change direction before they pull the trigger. Here's another name that is having a tough time in January: Clicks. The share price of this retailer is down 6%, a headache that may well become a migraine if this negative momentum continues for the next couple of months. Although Clicks has dropped to a lesser extent than the clothing retailers, they are seen as a more defensive business, and Clicks didn't have quite the same wild trajectory in 2024 that clothing retailers did. Still, that defensiveness of Clicks may be called into question in the next set of results. There are reasons to be concerned about gross margin at Clicks because the wholesale segment did their heavy lifting in the latest sales update. And there was also commentary about how promotional sales outperformed non-promotional sales. Personally, my bear case for Clicks is the shift to online sales in South Africa and what this means for the sale of high-margin front shop items at Clicks. They don't make much money at the dispensary. They make money from attracting you to the store to get your meds and then selling you stuff on your way out. But what if I bought that stuff online before I went to the pharmacy? Walgreens in the US has been really struggling, and it's not impossible that the same pressure comes to Clicks' door. I do think that Clicks can keep growing for a long time still, so the question is more around the risks to the growth rate, and particularly in the context of the steep valuation. Overall, the retail sector has had a very hard January. A lot of it is really just profit taking after 2024, but in some cases, there are some of them that are facing structural risks as well. Now we get to the good news. I was horribly wrong about Mr. Price, yes, but thankfully I was right about Cashbuild. It was $163 at the time of that podcast in mid-2024, and it's now at over 200 Rand, a return of 24%, yay. Although the recovery in sales is playing out too slowly for some tastes, I'm pretty happy here with mid-single digits and the grind. I prefer that to volatile ups and downs, although I do still believe that Cashbuild can deliver more exciting returns if interest rates drop further this year, and hopefully they will. This is also where the power of a watch list becomes so clear. I released that analysis in July last year and kept an eye on Cashbuild, waiting for the right entry point. The market delivered one soon thereafter in August with a really strange sell-off that took the price all the way down to 142 Rand. Through fundamental research, though, and an understanding of the drivers of the Cashbuild story, it just seemed far more likely than not that this was something irrational happening in the market. There was a big shareholder needing to get out, etc., etc. And Cashbuild is not the deepest, most liquid stock on the market, so this kind of thing can happen. Thankfully, it worked out well for me, and this is where I'm glad I'd done the work, thought about the stock, and put it on my watch list. I now have a return of 41% from Cashbuild, thanks to that better entry price. And it just shows you that if you can time the market, it really does help you, but it's a very hard thing to get right all the time. I'm still holding Cashbuild for all the same reasons as before, really, with a hope that consumer spending in that space will continue to recover. And in case you're wondering how Cashbuild has been doing in January, while other retailers have all been rolling over, the share price is down 4.6%. So yes, also in the red, but fancy that, a little bit of outperformance here by Cashbuild versus other retailers, albeit over a very specific period. So, will the retailers continue to get punished as we head into February? Will it be February, which is actually a better use of the term really than January? It really rolls off the tongue. Trying to guess what the market will do 1 month at a time is truly silly though, unless you're a trader actively looking to profit from short-term moves. So I'm definitely not going to give you a blow-by-blow forecast for 2025 because the only thing we can be sure of is that it will be wrong. What I will say though is this: Mr. Price is still on a PE that is just below 20x. It's sitting on a pretty important support level right now, and if that breaks, a nasty chunk of last year's gains could unwind. And this is pretty much the case across the sector. I'm just mentioning Mr. Price because they recently released an important update and the market response to it was not good, despite the fact that the update itself was strong. Fundamentally, there are reasons to believe that the multiple could come back down to earth, so such a downward move in the share price would not feel irrational to me. As all the other retailers start to release updates this year, it's going to be an important sector to watch. I have no positions in it other than Lon Cashbuild, and that's not really a retailer in the traditional sense anyway. It's not been a good January for retailers. Let's see what February holds. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.